Very tumultuous 2 days for the stock market. Another day of steep losses here.
Brutal day on Wall Street. President Trump's tariffs sparking a huge sell-off today.
We risk being squeezed out, marginalized, and left behind.
Are we going into a global recession? The stock market all over the world are plunging, the news headlines are devastating, and people started to question whether this is the beginning of the Great Depression 2.0. But before you panic sell everything, remember that many market crashes in history have created new millionaires. This might be your chance to become rich. How do you survive a crash? And most importantly, how do some profit while others lose? But before going there, let's first understand more about market crashes. The stock market doesn't just go up all the time. It moves in cycles with ups and downs. If you're investing for the long term, you need to understand that crashes are part of the game. In fact, for traders, these ups and downs are opportunities for them to buy low and sell high, because if stocks only went up, everyone would just invest long term instead of trading. Believe it or not, history shows that the market follows a repeated pattern of market downturns. The first is pullbacks, when stock prices fall around 5 to 10%. This happens almost every year and is considered normal market movement. The second type is corrections, where stock prices drop 10 to 20%, as the name suggests. Corrections happen when investors realize that the stock prices are overpriced and correct it back to their fair prices. Usually, it happens every 1 to 2 years. The third is bear markets, when stock prices fall around 20 to 40%. This usually happens every 5 to 6 years, often due to economic slowdowns or rising interest rates, because the economy isn't always good as a fairy tale. And the last is crash, when stock prices drop 40% or more. These happen about every 10 to 20 years, usually due to black swan events like financial crisis or global disasters. History has proven again and again that the market bounces back and even gets stronger after every crashes. For example, in 1973, the oil embargo crash sent markets down by nearly 50%, and it took about 7 to 10 years to fully recover. And during Black Monday in 1987, the New York Stock Exchange crashes 22% in one day, but recovered in 2 years. During the 2008 financial crisis, the S&P 500 crashed nearly 50%, but eventually recovered in 4 years. And during the 2020 COVID-19 crash, the New York Stock Exchange dropped 30% in just 5 weeks, but surprisingly, it fully recovered in just 4 months. So, different crashes and different timeline, but the same pattern happens where market falls and come back even stronger. But some people still panic and say historical performance doesn't guarantee future results. What if this time the crash is different and never recover? How do we know? That's not completely wrong, but there are indicators to help you know when a crash is just part of the cycle and when you should actually be worried. Crashes to a certain extent is still quote-unquote normal if you see the businesses are still operating and people can still spend and do leisure. You should only start to worry if the entire economy breaks down. For example, if businesses keep failing, banks go bankrupt, people cannot access their money anymore, and the country defaulted on its debt, etc. But in the context of Singapore, I don't think that will ever happen. Maybe in some other countries, but not Singapore. Those type of crashes will be much harder to bounce back from. Specifically about the chaos that is currently happening, I would say this is purely man-made. The market goes up and down because of Donald Trump. But if we are playing the game of chicken, I think he will blink and pull back first. For example, just a few days after announcing tariffs on all countries, he announced a 90 days pause because the bond market is about to crash. To me, this indicates that all of these maneuvers are just negotiation tactics and probably a bunch of ego, but it seems like Trump is also trying to avoid creating Great Depression 2.0. Now that you understand which crashes are normal and which ones are not, let's discuss how to survive or even profit during stock market crashes. A stock market crash might seem like the worst time to invest. You might be wondering, how do you even survive it? But here's the surprising part. Many people actually make huge profits during a crash. For some investors, a market crash is one of the best opportunities to build long-term wealth. Like Warren Buffett said, be greedy when others are fearful. So how do you actually do that? Let's go through some common mistakes and what you should do if you want to profit during a crash. The first mistake is panic selling. When people see their portfolio turning red, their first instinct is to sell everything before it drops more. But here's the truth. You haven't lost money unless you sell a stock, so it might be down, but it still has a chance to recover. But if you sell at a loss, then the loss becomes real instead of just paper loss. If you invested in strong, profitable companies, there's usually no reason to sell just because the market is down. Instead of panic selling, stay calm, stay informed, and focus on the long term. The second mistake is trying to time the bottom. Some investors try to predict the lowest point of a crash and wait for the perfect moment to buy. But the problem is, how accurate can you predict the lowest point? Many people wait too long and miss the lowest point, while others buy too soon thinking prices won't drop further only to see them fall more. Instead of guessing, a better strategy is dollar cost averaging or DCA. DCA means investing a fixed amount regularly, so you buy more when prices are low and less when prices are high. As long as you buy strong profitable companies, DCA should be a worry-free approach as long as you're confident in the company's long-term strength. The third mistake is buying bad stocks just because they are cheap. If you notice, I keep emphasizing buying strong, good, profitable companies. Why? When stock prices crash, it is tempting to buy anything that looks like a bargain. But the reality is, not all companies recover. Some business will fail completely and their stocks will never bounce back. That's why it is so important to focus on strong profitable companies. For example, those with low debt, solid earnings, history of surviving tough times, and good prospects. During a crash, great companies become cheap not because they are bad, but because everyone else is panicking. Then the fourth mistake is not diversifying. Some investors put all their money into one stock or sector thinking it will be a sure bet. But when a crash happens, some industries fall harder than others. Smart investors spread their investment across different sectors like tech, healthcare, consumer goods, and utilities. So if one area crashes, others can help balance the losses. Some even diversify into non-stocks like bonds, commodities, or international stocks to protect against stock market crashes. If picking individual stocks sounds hard, then you can consider buying funds like ETFs or index funds, which make it easier by automatically spreading your investment across multiple stocks. This way, you don't have to pick individual companies yourself. The next mistake is fear of missing out or FOMO. When panic spreads, people blindly follow what others are doing. If everyone is selling, they sell. If the news is predicting doom, they believe it. But even legendary investors have said that even Wall Street professionals cannot predict the market perfectly. So make sure you understand what you are buying by doing your own research. Like Warren Buffett said, never invest in something you do not understand. And of course, the last point is, investment always comes with a level of risk. That's why the general wisdom is, you should only invest the amount that you can still tolerate to lose, especially high-risk investments such as crypto, stocks, options, etc. If you foresee that you will need that amount of money in the short run, let's say within 1 to 3 years, then consider safer options to park your money, such as high-yield savings account, fixed deposits, etc. By the way, this is not financial advice and just purely my opinion. I'm just some random person on the internet, so please do your own research or even talk to a qualified financial advisor because your strategy should be based on your specific situation. So, when the next crash happens, get ready, but do not be overly afraid. If you want me to make more videos about financial topics like this, let me know in the comment section down below. Don't forget to like and subscribe, and I'll see you in my next video. Bye bye!